Hello students, welcome to the lecture on facilities for exporters, and after this lecture we will be able to learn the following objectives. Explain the facilities and incentives to Indian exporters, describe the EOU scheme and VAT, explain the income tax concessions, define the EPCG scheme and duty-free import authorization scheme, explain the DEPB and free trade warehousing zone, define the Star Export House. Let's start with the concept of facilities for exporters. The facilities available to exporters are based on the basic principle that taxes and duties should not be exported. Different export promotion schemes such as Export Oriented Unit EOU scheme, Export Promotion Capital Goods scheme EPCG, Advanced License scheme, Duty Entitlement, PASSBOok DEPB scheme, drawback scheme and similar other scheme accordingly provide for concessional duty or exemption of duty on capital goods and or exemption or refund or rebate of duties on raw materials and consumer. All imports required for authorized operation of a special economic zone SEZ unit are exempt from duties. The exporting industrial units outside SEZ are also eligible for similar exemptions on raw materials and capital goods if they operate under EOU scheme and on raw materials if under advanced license scheme. The only additional facility on imports for SEZ unit is exemption for the material required for constructing the unit premises. The purpose of the export finance facilities is to provide financial support to suppliers or exporters in the member countries to enable them to perform export transactions. Under this category, Black Sea Trade and Development Bank (BSTDB) offers pre-export finance, single or multiple supplier refinancing facilities and also export finance facility guarantees. Typically, suppliers or exporters' loans will be short-term. Longer tenors may apply to cases where traded goods have long manufacturing periods. Example, capital goods and or trade contracts terms provide deferred payment objects. Let us now discuss the facilities and incentives to Indian exporters. Promotion of export has been a major thrust area of the Ministry of Commerce and Industry for the last 3 decades. Apart from this, many other central or state ministries have also been involved in the promotion of India's export. Many export promotion council, public sector undertakings, chambers of commerce, industries, association and services organization are also contributing towards the promotion of Indian exports. The facilities and incentives presently available to the Indian exporters include the following: Marketing Development Assistance (MDA). The Ministry of Commerce and Industry has a scheme of MDA which was launched in 1963 with a view to stimulate and diversify the export trade along with the development of marketing of Indian products and commodities abroad. Market Access Initiative (MAI). The Ministry of Commerce and Industry has introduced the MAI in April 2001 with the idea that the government shall assist the industry in R&D, market research, specific market and product studies, warehousing and retail marketing infrastructure in select countries, and direct market promotion activities through media advertising and buyer-seller meets. Financial assistance shall be available under the scheme to EPCs, Industry and Trade Association and other eligible activities as may be notified from time to time. A small allocation of INR 42 crore has been made for 2002-03. Central assistance to states. The state government shall be encouraged to fully participate in encouraging exports from their respective states. For this purpose, a new scheme Assistance to States for Infrastructure Development for Exports ASIDE has been initiated, which would provide funds to the states based on the twin criteria of gross exports and the rate of growth of exports from different states. Towns of export excellence. A number of towns in specific geographical location have emerged as dynamic industrial location and handsomely contributing to India's export. These industrial cluster towns have been recognized with a view to maximizing their export profiles and help in upgrading them to move up the higher value markets. Special Economic Zone SEZ. The Government of India had announced an SEZ scheme in April 2000 to promote India's export for Export Processing Zone EPZ, namely Noida UP, Falta West Bengal, Chennai, Tamil Nadu and Visakhapatnam, Andhra Pradesh have been converted into SEZs from 1st January 2003. Export financing. Financial assistance extended by the banks to exporters at pre-shipments and post-shipment stages. While the pre-shipment finance is provided for working capital for the purchase of raw materials, processing, packing, transportation, warehousing, etc. of the goods meant for export, post-shipment finance is generally provided in order to bridge the gap between the shipping of goods and the realization of proceeds.
Every small business needs a steady flow of cash to run smoothly, especially when exporting goods. Exporting creates new growth opportunities and new challenges. It's a big hassle to chase invoices across borders. Language barriers and red tape mean your cash gap grows. And domestic banks usually won't fund international receivables. But there's another way to improve your cash flow, and it's called factoring, or accounts receivable financing. Here's how it works. You make a sale and generate an invoice to your customer with specific payment terms. You send the invoice to Bibby International Trade Finance. We buy that invoice from you and immediately pay you up to 85% of its total value. We handle the collection process, accepting multiple currencies and reaching your customers in their own language from one of our many worldwide offices. Once the customer pays us in full, we pay you the remaining 15% minus our fees. And to give you more flexibility, you can pair factoring with our purchase order financing service. Because it's based on your outstanding invoices, we don't discriminate against seasonal businesses or startups or companies that have hit hard times.
Technology Trade Promotion. The Department of Scientific and Industrial Research DSIR operates a scheme called Transfer and Trading in Technology TATT, under which it can grant assistance for technology export. Salient feature concerning technology export as announced in Union Budget 2002-3. Budget strategy: continue the emphasis on agriculture and food economy reforms, enhance public and private investment infrastructure, strengthen the financial sector and capital market, deepen structural reforms and regenerate industrial growth. Agriculture export. Agricultural Export Zone, 15 zone approved so far. Agriculture and Processed Food Products Export Development Authority APEDA will catalyze development of infrastructure and flow of credit to the units in these agriculture export zones. Television channels. India has technical capability to become an uplinking hub for television channels for the South Asian Association for Regional Cooperation SAARC countries. In order to promote state-of-the-art uplinking facilities at competitive cost, customs duty to be reduced on certain earth station equipment and studio equipment from 35 to 25%. Fresh investment, additional depreciation of 15% on new plant and machinery acquired on or rather 1st April 2002 for setting up new industrial units or for expanding the installed capacity of existing units by at least 25%. Information technology implementation of zero duty regimes under ITAI agreement postponed from 2003 to 5. Custom duty on a number of hardware inputs reduced to 5% and on certain capital goods to 15%. Duty on certain IT items would be reduced to 1% or 5% as per the WTO provision. Free trade zone, etc. and 100% export-oriented units. Restricted deduction to 90% of profits and gains as are derived by an undertaking from the export of articles or things or complete software for the assessment year 2003 to 4 only. Now moving on to the next topic, we will study the EOU scheme. The needs for higher level of technological and industrial progress made the government devise a series of export promotional schemes. EOU and SEZ scheme are one among them, which provides an internationally competitive duty-free environment coupled with better infrastructure facilities for export production. The EOUs now constitute a very important sector in the country's export production scenario. They have become dominant players in our export strategy, and their share in the country's export performance is about 10%. The export growth rate of 30% compares very favorably with the national export growth rate. The purpose of the scheme was basically to boost export by creating additional production capacity. Under this scheme, the units undertaking to export the entire production of goods are allowed to be set up. These units may be engaged in the manufacture, services, development of software, trading, repair, remaking, reconditioning, re-engineering, including making of gold, silver, platinum jewelry and articles thereof, agriculture, including agro-processing, aquaculture, animal husbandry, biotechnology, floriculture, horticulture, pisciculture, viticulture, poultry, sericulture and granites. General conditions of duty-free import. The facility of duty-free import extending exemption both from basic and countervailing duty is subject to certain general conditions in accordance with the EXIM policy, and these are summed up as: the goods are required to be imported into the EOU premises directly. However, granite quarrying units, agriculture and aided sector units are allowed to supply or transfer the capital goods and the inputs in the farms or fields with prior permission of custom. Prior to undertaking import or local procurement duty-free, the unit is required to get their premises customs bonded. The unit is also required to execute a B-17 bond surety security with jurisdictional customs or central excise officers and take out a license under Section 58 of the Customs Act 1962. The goods, except capital goods and spares, are required to be utilized within a period of 1 year or within such period as may be extended by the customs authorities. The importer is required to maintain a proper account of the import, consumption and utilization of all imported or locally procured materials and export made and submit them periodically to the Development Commissioner or Customs. Import and export procedure. With regard to clearance of import cargo, the EOUs are placed in a special category eligible for fast-track or green channel clearance through the customs. Clearance of import consignments is allowed at the gateway port air cargo complexes on the strength of procurement certificate issued to EOU by the jurisdictional assistant commissioner or deputy commissioner. In general, the EOU cargo is not examined at the gateway port. In case of loose cargo, marks and numbers on the packages are verified. As for sealed containers, the seal number and container number are verified with the bill of lading. Let us now know the meaning of VAT, value added tax. The VAT is a multi-stage tax levied at each stage of the value addition chain with a provision to allow input tax credit ITC on tax paid at an earlier stage which can be appropriated against the VAT liability on subsequent sale. The VAT is intended to tax every stage of sale where some value is added to raw material, but taxpayers will receive credit for tax already paid on procurement stages. This VAT will be without the problem of double taxation as prevalent in the earlier sales tax laws. Presently, VAT is followed in over 160 countries. The proposed Indian model of VAT will be different from VAT as it exists in most parts of the world. In India, VAT has replaced the easier state sales tax system. Heterogeneity prevailed in the structure of tax as well. Apart from general sales tax, most states used to levy an additional sales tax or a surcharge. In addition, the states levied luxury tax as also an entry tax on the sale of imported goods. All these practices of heterogeneity in structure as well as rates cause diversion of trade as well as shifting of manufacturing activity from one state to another. How can VAT address these issues? Under the VAT regime, due to multi-point levy on the price including value addition at each and every rescale, the margin of either the reseller or the manufacturer would be reduced unless the ultimate price is increased. VAT would not cause cascading nor would it cause a vertical integration of firms. Also, it provides total transparency of the incidence of tax. This is because VAT is a multi-state sales tax levied as a proportion of the value added. It is collected at each stage of the production and distribution process, and in principle its burden falls on the final consumer.
VAT, or value-added tax, is a tax based on the value of goods or services. VAT is charged when a VAT-registered business sells goods or services to another business or to a non-business customer. VAT can be shown on top of a price if it's a business-to-business sale and will be shown within the price if it's a direct-to-consumer sale. For example, a business sells a mobile phone direct to a consumer. The price is £120. If the rate of VAT is 20%, then the VAT included on this transaction will be £20. When a business charges VAT on a sale, they're collecting that money on behalf of HM Revenue and Customs. If a business is VAT registered, they can reclaim the VAT they've paid on purchases. The difference between what they've charged on sales and what they've paid on purchases must be sent to HM Revenue and Customs. If this is a negative figure, then it means they've more to reclaim than they've charged, and HM Revenue and Customs will send the business the amount due. Any business selling VATable products or services can become VAT registered. However, businesses with a turnover above the VAT threshold will be required by law to register. Once VAT registered, a business will need to charge VAT at the applicable rate on all VATable sales to UK customers. VAT must be charged on sales to EU-based customers without a valid VAT number, and will not be charged on sales to EU customers with a valid VAT number. If a business sells to any other country, VAT must not be charged.
Rebating, returns and billing under VAT. In case of manufacturer, input tax rebate is available only on the purchases made in the state of Karnataka and on the basis of tax invoice issued by the dealers, sellers goods to the manufacturers. Taxes or duties paid on other types of purchases, namely interstate purchases, interstate consignment, received and international imports, are not eligible for input tax rebate. Output tax is to be charged and collected on the sales made in the state of Karnataka. However, on the interstate sales taxes under CST Act could be collected separately or it could be included in the sale price also. Composition scheme under VAT Act registration and payment of taxes under VAT Act can be of two types. First type is the registration and payment of taxes under full VAT, and second type is the registration and payment of taxes under composition. Features to be noted by composition dealer. The composition dealer will be provided with a certificate of composition called Form VAT 8. The dealer applying for composition scheme shall be collecting regular rate of tax under Section 4 till he gets a certificate. After service or certificate of registration under composition, such a dealer is barred from collecting the tax. This is clearly mentioned in the said certificate. No tax invoice meant for full VAT dealers can be raised by dealer under composition. They should raise sales invoice as prescribed under the VAT rules. The composition dealer is barred from taking input tax credit. The input tax credit even on the transition stock is also not allowed. Income tax concessions. Modification by Unit Budget 2010. According to Union Budget 2010-11, a few changes have been made in income tax structure. Modification. The relaxation limit under Section 80C has been increased to INR 2 lakhs. The presumptive tax limit has also been raised to INR 60 lakhs. Announcement of a deduction of INR 20,000 on investment in infra bonds for the current financial year 2010-11. Following procedure is to be followed. EPCG scheme. Export Promotion Capital Goods EPCG scheme allows import of capital goods including spares for pre-production, production and post-production at zero duty for specified sectors and at a concessional rate of 3%. Custom duty for all sectors, subject to an export obligation ranging from 6 to 8 times of duty saved on capital goods imported under EPCG scheme to be fulfilled in 6 to 8 years reckoned from authorization issue date. Zero duty EPCG scheme, which had come to an end on 31st March 2012, have now been extended up to 31st March 2013 for continued technological upgradation of export sectors or units. Zero duty EPGC scheme was not available to units that are available the benefit of TUFS. Henceforth, even if the benefit of TUFS has been availed, additionally the zero duty EPCG authorization can be availed for another line of business by the same applicant. Further, if it is the same line of business, zero duty EPCG scheme could still be availed if the benefit of TUFS already availed is surrendered, refunded with applicable interest. Duty-free import authorization scheme. A duty-free import authorization is issued to allow duty-free import of inputs which are used in the manufacture of the export product, making normal allowance for wastage and fuel, energy, catalysts, etc., which are consumed or utilized in the course of their use to obtain the export product. However, the Director General of Foreign Trade, by means of public notice, may in public interest exclude any products from the purview of this scheme. Entitlement. The authorization shall be issued on the basis of inputs and export items given under Standard Input and Output Norms (SION). Their input entitlement shall be limited to the quantity mentioned in SION. Duty-free import of mandatory spares up to 10% of the CIF value of authorization which are required to export it or supplied with the resultant product may also be allowed under the scheme. Duty Entitlement Passbook Scheme DEPB. The Duty Entitlement Passbook Scheme is a part of Duty Remission Scheme. For exporters not desire of going through the licensing route, an optional facility is given under DEPB. The objective of DEPB is to neutralize the incidence of custom duty on the import content of the export product. The neutralization shall be provided by way of grant of duty credit against the export product. The DEPB scheme will continue to be operative until it is replaced by a new scheme which will be drawn up in consultation with exporters. Airports: Ahmedabad, Bangalore, Bhubaneswar, Mumbai, Kolkata, Coimbatore Air Cargo Complex, Cochin, Delhi, Hyderabad, Jaipur, Srinagar, Trivandrum, Varanasi, Nagpur and Chennai. Free Trade Warehousing Zone. A free trade zone FTZ or export processing zone EPZ, also called foreign trade zone, formerly free port, is an area within a country in which goods may be landed, handled, manufactured or reconfigured and re-exported without the intervention of the custom authorities. Genesis. In India, free trade and warehousing zone was introduced in the EXIM policy with the objective to facilitate import and export of goods and services. Objective. The objective of FTWZ is to create trade-related infrastructure to facilitate the import and export of goods and services with freedom to carry out trade transaction in free currency.
See, the free trade warehousing zone concept is very new right now in India, and we are the first free trade warehousing zone to be notified by Government of India and setting it up in Shri Perundur here in Chennai. Now, free trade zone concept is essentially like what you get to see in a place like Jebel Ali or in Singapore, where essentially the companies that are doing trade and exports over there are trading companies. Now, India is on the east coast, and this is going to be on one of the fastest growing shipping lanes between China, Japan, Korea and India, and Chennai is going to be the most important shipping port, and as a result of which we see a lot of companies both from the Far East as well as from the US and Europe looking to set up their trading hubs here in Chennai, where goods and products will be kept here in the free zone, invite domestic customers to come inside a tax-free zone, look at these goods and products and take just-in-time deliveries. At the same time, the foreign suppliers can use the free trade zone as a distribution center for the entire region, which means they are not only looking at the large domestic market, but they are also in a position to tap the market within the region. Shipping time from Chennai to a place like Dubai or in West Asia is under 8 to 10 days. Shipping time from Chennai into the Far East or into South Asia like Singapore or Vietnam is similar, 8 to 10 days, which means a US company which is looking to sell its goods and products into this entire region can create a distribution center in the Chennai Free Trade Zone. This is essentially what we are trying to offer to our prospective clients and customers as a unique selling proposition. Presently, our closest competition is coming out of Jebel Ali in Dubai. So and Jebel Ali does not offer any large domestic market. In India, we not only offer a large domestic market, but we also offer an opportunity to capture the Asia Pacific, or in this region, the footprint in this entire region. That's an additional advantage that we are looking to offer. Plus, the Indian SEZ policy, and by which we are really covered and governed by, is certainly a lot more aggressive and more efficient than similar policies being offered by China, by Malaysia, or by a lot of other countries. Dubai, of course, is a little bit of a difference, because Dubai is tax-free in any case, but they have other issues like taking in a domestic partner, not being able to own the companies over there, and a lot of other restrictive factors which we are not covered by over here in India. And as a result, when you really compare with what Jebel Ali and China and the other countries really have to offer, we have a far more aggressive model.
Star Export House, merchant as well as manufacturer exporters, service providers, EOUs and units located in SEZ's Agriculture Export Zone AEZs, Electronic Hardware Technology Parks EHTPs, Software Technology Parks STPs and Biotechnology Parks BTPs shall be eligible for status. Applicant shall be categorized depending on his total FOB for deemed export performance during current plus previous 3 years taken together upon exceeding limit below. For Export House EH status, export performance is necessary in at least 2 out of 4 years, that is current plus previous 3 years. Now in the end, let us summarize what we have learned in this lecture. Promotion of export has been a major thrust area of the Ministry of Commerce and Industry for the last 3 decades. Financial assistance shall be available under the scheme to EPCs, Industry and Trade Association and other eligible activities as may be notified from time to time. The Export-Import Bank of India EXIM Bank provides financial assistance to promote Indian export through direct financial assistance. The Department of Scientific and Industrial Research DSIR operates a scheme called Transfer and Trading in Technology TATT, under which it can grant assistance for technology exports. The EOUs now constitute a very important sector in the country's export production scenario.